Is everyone ready? Yep. Okay.
Let's start.
Please check. Yeah. Think about it for a second. Are we experiencing a modern history of David and Goliath? Are investors having too much faith in the giant? We believe that is the case for Tomra. And in the next 10 minutes, we're going to show you why. I'm here today with Philip, Nikolai, and Christopher. My name is Jens, and we are representative of Copenhagen Business School.
And today we're here to present to you our sell recommendation of the Tomra stock with a target price of 117.4 and a downside of 9.7%. First, we'll guide you through the financials and afterwards our valuation. But let's first have a brief description of the company. Tomra focuses on two main business segments, collection and sorting. The collection focuses on reverse vending and material recovery, whereas the sorting segment focuses on food, mining, and waste industries. In our presentation, we focus on these, as these are the primary revenue-generating units. Worth mentioning is that Tomra recently expanded their food sorting segment through the acquisition of Compac. Tomra is a leading provider of solutions within these business areas. This position is maintained through several competitive advantages, ensuring superior performance. Firstly, these cover the attainment of synergies across divisions. The TCS and TSS both employ sensor-based technologies. And the organization is therefore capable of utilizing similar components, knowledge, and technologies, enabling economies of scale. Economies of scale is further enabled through their worldwide operations and market-leading position. Tomra has a reputation for high-quality products, facilitated by their immense experience within the field and high investments in R&D. Let's now turn to an overview of the industry. Growth rates in the reverse vending is low as markets have matured, and replacement cycles in Sweden and Germany nearing their ends. Furthermore, conditions in the sorting segment are expected to challenge actors in these industries, requiring for the companies to adapt to changing demands and trends. Failure to do so will cause profitability to suffer. The changing conditions in the markets change the need for economies of scale, differentiated products, and technological superiority as key success factors. Jens will now guide you through the competitive landscape of Tomra.
Thank you, Philips. As we start off with the reverse vending machine market, we see that Tomra accounts for 75% of the market. They have the highest EBITDA margin, they have the highest geographical presence, and they have the highest spending in R&D. Considering the market as a whole, we expect the market to increase in size as new markets open up in Scotland, Australia, and also potentially in England. We expect Tomra to get a fair share of these markets, and therefore we don't see any changes in the competitive position going forward in this segment towards 2021. Going to a food sorting segment, we see that Tomra has a medium to low EBITDA margin compared to their peers, and also they have a relatively low investment in R&D compared to their peers when allocated after revenue. Considering the market of food sorting, we expect it to raise as we see an increasing demand for food safety and quality. Considering the last segment, waste sorting, we see that Tomra maintains a medium EBITDA margin compared to their peers, and also they have a pretty high geographical presence. Considering the market as a whole, we expect it to increase in size as well because of several megatrends such as increasing urbanization and increasing environmental focus, and also increasing labor wages may talk in favor of replacing manpower with machinery, lowering the production cost. I will now grant the microphone to Nikolai, who will talk about the valuation.
All right, so our valuation is based on an 80-20 distribution between DCF modeling and EV/EBITDA multiples. Using our DCF model with a heavy weight, we've attained a price of 117.4 Norwegian crowns. To complete our DCF model, we've had to calculate Tomra's weighted average cost of capital. Two highlights here is the risk-free rate, which is a revenue-weighted average, and our return on equity, which is quite similar to our WACC. This is because it's weighted very heavily in our calculations. I'll now give the microphone to Christopher so we can guide you to the rest of the valuation.
Thank you, Nikolai. Using the WACC derived from before, we arrive at a DCF valuation of 115.6 per share, a downside of 11%. The DCF valuation is mainly driven by two major value drivers, namely the revenue growth and EBITDA margin, both of which have been affected by the Compac acquisition. Worth noticing is that we have set the terminal period in our valuation to 2021, and the growth in the terminal period is set to 2%. Looking at the revenue growth, we see that the growth is expected to be the highest in 2017. This is due to the Compac acquisition. However, it is pulled somewhat down by lower sales of REMs in the German and the Swedish markets. If we look at the different segments of the different divisions, we see that the segments in the sorting division is providing much higher revenue growth than the collections equivalents. This will make the sorting division the highest contributor of revenue by 2020. Looking at the EBITDA margins, we see that the overall EBITDA margin of Tomra, as well as the EBITDA margin of the sorting division, is expected to take a cut in 2017. This is due to the Compac acquisition, where Compac only contributes with around 5% of an EBITDA margin. However, we expect the EBITDA margin of the collection division to be fairly constant over the period. The normalized level of the EBITDA for Tomra is also expected to get a bit down, as the sorting division has a lower normalized level of EBITDA than the collection division. Furthermore, we have supplemented our DCF valuation with multiple valuation of the EV/EBITDA multiple, where we have set comparables on fundamentals such as revenue growth, EBITDA margin, and enterprise value. Combining those two together, we arrive at our target price of 117.4. Furthermore, you should notice that an opening of the English market will increase our target price of around 13 to 20 Norwegian crowns per share.
All right, so to assess how changes in Tomra's fundamentals would impact our analysis and valuation, we performed a sensitivity analysis. If you look at the bottom table, you can see that an increase in both EBITDA margin and revenue growth would result in a target price of about 138.3 Norwegian crowns. At this price, we would only issue a hold recommendation, so even at significant changes, our valuation wouldn't be that much different. So our assessment is that our valuation is quite robust. We've analyzed 11 different risks for Tomra, but let's just go through a few highlights. First is Compac. We see the turnaround of Compac as highly critical, since it's quite a big part of their sorting solutions now, and a failure to turn it around would result in significant losses, both in profits and in their EBITDA margins. Secondly, the R&D. If Tomra fails in this part, they would lose a lot of market shares, since they compete in very technologically reliant markets. However, we do assess the risk of this being quite low, since Tomra has about an investment of about 8% of their yearly revenue into R&D, as well as an immense experience in the field. Lastly, Tomra is quite exposed to currency fluctuations, since they don't use currency hedging. Tomra themselves estimate that a 10% change in the Norwegian crown would result in about 8 to 12% change in their profits. So, in summation, Tomra is actually quite a good business case. However, there are several chinks in this giant's armor, as we spoke about with Goliath, and as such, we issue a sell recommendation at a 12-month horizon. Thank you very much.
Do you want some water before you have your questions? Or?
That could be a good idea.
Yeah. All right. Well, thank you very much, guys. Is the mic on? Yeah. All right. Well, thanks for the presentation. Let me kick off the questions on valuation. You used two methods, DCF and a multiple-based approach. You weighted it 80-20. Could you perhaps tell us why you chose these two methods and why you weighted them as you did?
Should I take that?
Yes.
Yeah. We chose the DCF as it is a main, as it has a normal method to use in the valuation of companies, where we have looked at the projected cash flows. We have used the dividend-based model, where we assume that every leftover cash that is not paid out as dividends is invested in the company at an NPV level of 0. We have supplemented by the multiples, as we deem it somewhat unsecure to only base evaluation upon the DCF valuation, and the distribution between those two is chosen as it is hard to find peers and comparables for Tomra. So therefore a high weight of that method would be somewhat stupid and maybe give a wrong result. Therefore, the high approach, a high level of DCF valuation.
And maybe just one follow-up. What is the main advantage of using DCF?
It's the cash flow predictions. It's the cash flow looking forward. And then we supported by the multiples by getting the market prices in. And that's what I thought about that. Thank you.
Yeah, thanks, guys. Just correct me if I got this wrong, but did I understand that you have in your terminal value in your DCF, you had a 2% growth rate on revenue? What does your target look like if you take that up to 3.5%?
Given that sensitive analysis.
Yeah, but we made it. I can't remember the exact number, but I think it would be around around 35 and 140. We haven't included in the slide pack. We should have done it, of course, but I think it's between 135 and 140.
Okay, and you also mentioned that if England were to open, you see another 20 krona.
Yeah, 13 to 20.
At what probability would you put England opening up at the moment?
In England?
Currently, 10-20%. It is based upon England being largely being much similar to the Scotland, which is projected to open. It is decided in the Scottish Parliament that it will open up soon, and then we think that England will follow up, as they can draw on the experience from the Scottish market, and the Scottish people and the English people is somewhat similar.
Yeah, so if I may add, the English market depends very much on the success of the Scottish market. So if the Scottish market becomes a success, we might see an English market open as well. Therefore, we have a low probability of it opening right now, as we can't say any more about it before we see the Scottish market.
I think you mentioned that in your DCF valuation, you reinvested, capital at 0% return on capital. What has Tomra done historically? I mean, they have done a lot of acquisitions and also spent quite a bit of money on CapEx. Do you have any sense of how effective that spending has been? What kind of returns they have generated?
It's been somewhat different. Some of the acquisitions they have made are going successfully. Others that they have made are sold off again, as they didn't make the projected dividend that Tomra expected. In that case, could be mentioned Norway and Persona, which were bought in, I think it was 2006 and sold off in 2010, 2012. So it's different. It's dependent on the case, but deeming at the compact acquisition, it looks like that it will contribute to the overall performance of Tomra. However, we look at the 12-month side, and in that case, we see a sort of recommendation.
Yeah, and then on the margin expansion in the food business, what levers can Tomra pull in order to increase the margin back up to 18%? What needs to be done?
I'm not sure I understand the question. Can you clarify a little?
So how can Tomra take out costs or increase revenues, get the operational leverage in order to get the margin up to the historical level that you assume in
Well-
evaluation?
Well, in our view at least, Tomra is quite experienced in the field already, and as such, implementing their already established business practices into Compact specifically, because Compact has actually dragged down their EBITDA margin. Implementing their business practices there would at least help quite a bit in that regard. Furthermore, it might not be possible for them to drag the EBITDA margin all the way up to the same place as RVM as such, but it might be possible in the future. But at our 12-month horizon, we don't really see it as a possibility that they could develop their EBITDA margin that much.
What we have seen, we may expect horizontal acquisition within the industry of Tomra.
In your multiples approach, what kind of peers have you been comparing Tomra with?
So our approach was to Tomra is a hot business because it's very diversified. So we decided to look at fundamental with the same growth, with the same business risk, and therefore we chose our multiples by that. It's hard to find a similar business who has operations in every aspect as Tomra. So therefore we chose to look at the fundamentals and compare it by that.
All right. Where do you think you could be wrong?
It's all estimation, so particularly we could be all wrong. So you're asking about our weaknesses somehow.
Well, I mean, given that the share is trading above your target price, what is it that somebody else see that you aren't seeing, or?
Maybe we could use a WACC that's too high. We could have estimated something wrong. It could be the risk-free rate. It could be the market premium. It could be anything.
Yeah. Furthermore, we're quite conservative in some of our estimates, but that might just be because we're a little risk averse.
Also, people can be optimistic about the Tomra share because it is a good investment case, and our recommendation relies on a one-year target. And therefore, if people tend to hold it, especially when you think about 26% is held by Latour, which is an investment association, so they may have a longer horizon than we did.
Just to follow up on my colleague here, I think what's actually, well, you probably know this. What's the current price earnings ratio for Tomra for 19?
On reported figures, 27, 26.
What do you think? What do you think the market sees? Why are those estimates? Why is the share price where it is today? What's missing here in terms of what you see? Like, is there any, except from leaving aside your WACC assumptions, but just on the pure earnings side, what's expected from the market that you probably don't expect?
It could be that we have set the terminal period to be 2021. If the market looks at a longer period, they could catch some growth opportunities in the future that we haven't included in our estimates, which shows the 2021 level as it is deemed by us to be a secure margin. If we go any further into the future, it could be hard to tell what's really going to happen. Furthermore, there could come new competitors in from the right that could totally turn upside down on the market and just catch it all because they have a better solution than Tomra.
Just to add on that, it may also be that synergies are attainable more than we have expected or in our estimates have accounted for. So, if investors believe that synergies can provide Tomra with higher competitive advantage, that may increase their expectations.
And on top of that, the entire business case is well supported by these mega trends, and therefore the market might be willing to pay a premium to get into the stock.
If you were in Tomra's shoes, what would you do the next 12 months as a company?
make sure that the Compac acquisition is going well. And furthermore, you see that they just recently had bought a new company in New Zealand.
Good.
Thank you for your attention.